accounting for sole proprietorship. It is a fact that there are so many businesses that operate under the sole proprietorship model. So we thought it as useful to bring a tutorial across that will help such businesses be able to understand how that model operates and how they'll be able to keep their books in order to ensure success and progress. So we're going to start with the definition of what a sole proprietorship is. So it is basically a business that a single person puts resources together to found and also seeks to manage that business. Now, the fact that it is being founded by one person doesn't mean that it doesn't get to have employees. Let's look at the features of a sole proprietorship. The first we're going to look at is that it is an unincorporated entity, meaning it is not registered to be legally separate entity, unlike the limited liability companies that a business registered under that model is deemed as a legal individual separated from its owners. It means that it doesn't get to trade in shares. Secondly, a sole proprietorship type of business shares the same identity as that of the proprietor. So in the eyes of the law, whenever someone is dealing with the business, it is deemed as being trading or transacting that business with the proprietor, him or herself. And thirdly, it has unlimited liability, which means that the proprietor is solely responsible for whatever debt that the business will incur, and the limit to which the proprietor is liable for those debts is not restricted. It means that the personal belongings of the proprietor or the proprietress will be fallen upon in event where the resources contributed to establish the business does not suffice to cover the liabilities that will come up in case the sole proprietorship is wound up. So if the capital invested in the business is, let's say, 100,000, and the business encounters challenges and has to be terminated, and the liabilities that arises, let's say, 120,000, the capital involved in the business, which is the 100,000, will cover a bit of the 120, and then the proprietor or the proprietors will be required to pay the balance of the 20,000. This is different from the limited liability companies, where the liability of the owners is restricted to the capital they contribute into the business. Let's look at the benefits or the advantages of operating under the sole proprietorship model. Here, it is very easy to set up. The process involved in establishing a sole proprietorship is relatively easier than limited liabilities. So all you have to do is to pick a form, fill it out. You don't need to get a director. You don't need to present an auditor to sign up before you are registered. Secondly, it is less costly to run because all you need is yourself as the sole proprietor. You contribute resources, possibly get employees to assist in the administration of the business. You don't need to get a director, a board that you will be paying them. Neither do you need to have an auditor who would have to peruse your books at the end of a period and then supply it to a regulator. It is also advantageous in terms of decision making because the owner has the sole mandate of running the business. He doesn't have to share ideas with a board or a partner. And lastly, because the business is owned and controlled by the sole proprietor, he doesn't have anybody to share control. So whatever decision making that has to be brought up by law or by convention, he doesn't have to consult another person in order for that decision to be implemented. For limited liability companies, you must have shareholders sit at a meeting and get majority of them to buy into a decision that has to be implemented. On the other hand, there are certain downfalls or demerits. The first we'll look at is that it is riskier, as we saw in the previous slide. The proprietor's liability to debt is unrestricted. Secondly, a business that is registered as a sole proprietor is deemed a bit riskier because it is owned and manned by a single individual. So, for example, if such a business wants to go for a contract, they don't believe that business to be substantial compared to one that is legally deemed to be separated from its owners, because the owner can just decide to dip their hands into the coffers or make a decision that will go against the business. So people will be hesitant in entrusting their businesses or transacting businesses with such an entity. Thirdly, because the sole proprietorship shares the same identity with the owner, once the owner passes or is disinterested in progressing with the affairs of the business, that automatically or legally terminates the existence of the enterprise. That in a bit also adds to the lower credibility that is assigned to the business. Then lastly, there's a challenge of limited resources available here, because the resources to run the business must come from the sole proprietor. It doesn't have the option of falling on people to contribute resources or build wealth to run the business. So he might have to go for loans in their personal capacity, and that presents a bit of a challenge whether they will be successful in that regard. For partnership, you have a couple of people who join forces to raise the capital, and you might even invite more people to join the business when need be. For limited liability, you float shares, so people who buy into the vision of the business can contribute their resources to help. Let's look at how sole proprietorship runs accounting wise. They will prepare their profit and loss as all businesses do. They also prepare balance sheets as also businesses do. So the profit and loss at times is called the income statement, and the balance sheet is called the statement of financial position. So profit and loss will capture revenue, which is the earnings of the business for a particular period, predominantly a year. And it is less by any expenses and losses that the business incurs in running that particular line of activity. The balance sheet, on the other hand, operates on the accounting equation. So taking a critical look at the accounting equation, the formula is assets equal to capital plus liabilities. So whatever the business owns must equal to what is contributed and the obligations that they have incurred to run the business. So assets will comprise of property, which might be a building, a land, motor cars, machinery, cash and bank, and possibly short-term investment, and then inventory, what the business produces or buys for resale. Capital, on the other hand, will comprise of the proprietor's initial resources that is put into establishing the business. They will add any profit that the business generates. That is when they are able to earn more, to be in excess of the expenditure that they incur in the course of operating the sole proprietorship business that they have established. Then, one thing to note about sole proprietorship is that anything that relates to the owner will not be captured in the preparation of the profit or loss. So the sole proprietor is not entitled to a salary, is not entitled to lift any goods that the business is trading in for personal consumption. Neither are they entitled to any loans or any interest on capital. Whatever that is attributed to the owner is termed as drawings. Then the liabilities will include obligations, maybe loans that the business take. They have people they buy from on credit, and then you have accruals when they incur an expense and they pay beyond the due date. Let's test our understanding. So this is an extract from Winky Enterprise, the trial balance for the year ended 31st December 2024. So we have salaries, receivables and payables, return inwards, sales, discount allowed, discount received, inventory at the beginning of the year, which serves as that at the end of the previous year, purchases, carriage inwards, return outwards, inventory as of the end of the year we are considering, which will serve as the opening for the subsequent year. Then we have bad debt, cash in hand, drawings, bank overdraft, insurance, rate, electricity, capital, land and building, furniture and fitting, equipment. So as we have learned in the preparation of financial statements, for a trial balance, the totals of the items debited must equate the ones credited. So we have the same figure as you can see. So we are required to prepare the statement of profit or loss for the year ended 31st December 2024 for Winky Enterprise, and then continue to prepare the statement of financial position as at 31st December 2024. Let's come to the solution. We're going to start with the statement of profit or loss for Winky Enterprise for the year 31st December 2024. So the statement of profit or loss normally captures the operations of the business and tell whether they were able to generate more revenue in excess of the expenditure. If the other hand is the situation where the revenue generated fell short of the expenditure, then that will be a loss. So we start with the sales, then we less return inwards. Now these are sales that were made to customers that got returned. Maybe they were defective or they received the wrong order. That is going to give us a net sales of 198,000, the difference. Then we come to cost of sales. We need to know the cost of the main items that the business is trading in before we add other non-direct expenses. So opening inventory, that is the inventory at the end of the previous year, that is 31st December 2023, was 16,000. The business believed that it wouldn't be sufficient to cater for the intended operations for the current year, so they purchased extra 35,000 to add up. And then this purchase, they spent 6,000 in bringing those items to the place of operations in order to augment the activity. So that will be added. And then these purchases, some were found unworthy, so they were returned to the supplier. That gets deducted. Now, this will lead to the items that the business is prepared to trade in order to generate revenue. But then they were unsuccessful in selling the entire stock available. So there was a balance of 15,000 of inventory left that will be deducted because that didn't contribute into the net sales of the 198,000. What this means is that the 198,000 that they generated, it came from stocks that cost $41,000. When you deduct these two, that will give you the gross profit of 157,000. That is the 198,000 less the cost of sales of 41,000. So the business was able to generate $157,000 from its core operations. Now we transfer the gross profit here to continue our preparation of the profit or loss. Now we get to deduct the other expenses not directly related to the business's operation. So salary 50,000. Now this salary will relate to staff working for Winky Enterprise. Without that paid to the owner of Winky, then we less discount allowed because it's an expense. You were supposed to sell the item for $10,000. You sold it for 9,000, meaning you have incurred a shortage of a benefit. Now, bad debt, an amount that will not be able to be retrieved from customers, so you treat it as an expense. Insurance is an expense. Rate is an expense. Then we have electricity, giving us 69,000. This will lead to a net profit of 88,000. That is when we deduct the non-core expenditure from the gross profit. When we proceed to the statement of financial position as at the year ended 31st December 2024, we are going to start with assets. So the financial position is assets being equal to the sum of equity, same as capital, plus liabilities. So we are going to tabulate the asset of the business. So non-current asset will come first, which is the land and building. So non-current assets are resources that will be used in the business operation over a 12-month period from the time of preparing the financial statement. So buildings will last for more than 12 months. The cost of it is 68,000. Furniture and fittings will also last for more than a year. So it is put under non-current, 41,000. Then equipment, 50,000. The sum of which will be 159,000. Then we bring the resources that are not meant to last for more than 12 months. So we have inventory. Some inventory are not perishable and they can last for more than 12 months. But the idea is that the intention for buying the inventory is supposed to be sold within a period less than 12 months. So when we deal with real estate businesses, even though they are selling land and buildings, which has a lasting period of more than 12 months, they expect to dispose them off and make money within a period of less than 12 months, even within a month. So for them, the building will be deemed as an inventory and come under current assets. Then we have receivables. These are people that the business has sold to and are yet to redeem their debt, 40,000. Then we have cash in hand, monies that are sitting in the business, 50,000, giving a total for the non-current asset to be 105,000. That will lead to the balance of the assets to be 264,000. That is the summation of the non-current asset 159 and that of the current asset 105,000. Now we continue with the equity and liability section, which is the right side of the accounting equation. So we'll start with the equities, which is the capital. So the 170 serves as the initial contribution that the proprietor put in Winke Enterprise. Then we add the profit that we realize, 88,000. It is added up here. That is deemed as the salary of the sole proprietor. Now there is a drawing of 5,000 which will get deducted. Now the sum of the equities will give us 253,000. Then we come to the liabilities. We have people that they have traded with and are yet to pay. That is the payables or creditors, 10,000. Then we have overdraft, okay, of 1,000, which is a short-term loan that a business secures from a financial institution. The sum of these liabilities will give us 11,000. So the sum of the equity and liabilities gives us 264,000. So once it conforms or tallies with the total of the assets, it means that our balance sheet or our affairs are in order because the equation has balanced.